So good afternoon, everyone, and a very warm welcome to the Foreign Correspondents Club of Japan. My name is Peter Langen. I'm a correspondent at Asia Times, and I'll be trying to be your moderator today. Before I introduce our guests, could I ask that everyone either switch off or mute your cell phone, which is what I'm doing right now, so that we don't get interrupted. Thank you. So our speaker today has had, as you can see from the release, a very interesting career, both inside the financial world in investment banking, working at our old favorites, Goldman Sachs, Lehman Brothers, and Bear Stearns. From that, she took the experience and stepped away, if you like, to write about the world of finance, but it takes a very interesting perspective of putting it in context of the history of the relationship between finance and power, particularly in the United States. So I definitely recommend at least one of her books that I've read. I haven't completed it, sorry, but I'm getting there, which is All the President's Bankers, which is a fascinating read, as I say, on the history of money and power in the United States. And of course, that's the same story that's being played out today in different forms. So I won't ramble on because our speaker has far more interesting things to say than I do. So I'll just ask again if you can extend a warm welcome for our speaker today, Miss Nomi Prins. Thank you.
Thank you, Peter. Thanks to the Foreign Correspondents Club. It's nice to be back. I don't know how many of you were here. Well, I see some familiar faces. When I was here in November, right after we elected President Trump, or our country elected President Trump. Anybody? Some of you. Well, just for those of you who weren't here, I'll just summarize. But I had no voice. Like, I physically had lost my voice last time I was here. So if you were here, you probably didn't hear very much. So I might wind up repeating things that I said that was inaudible. But a lot of things have happened in the last months since I was here, of course, in the world, in finance, with respect to trade alliances and other types of relationships amongst countries in the Trump era under the Trump doctrine. But what I wanted to do, and I have slides, by the way, for you. We'll put them up, I think, on the website or somewhere where you can get them. I'm not going to necessarily go off of all of them. There's too much going on, and as much time as I spend recreating slides, as you know, as journalists, things happen and the world changes. So it's kind of just a guideline. But a couple of things that I wanted to put, as Peter mentioned, the perspective of where the U.S. is and was in terms of banking and finance, how that related to power and politics, both in the past, the recent past since the financial crisis of 2007, 2008, how that basically catalyzed Trump's rise to be the president, and how that's also shifted the world in terms of alliances amongst other countries outside of the U.S. That had started during the years since the financial crisis and have accelerated very quickly since Trump has become president. So of course Trump now, and you all cover the G20, I'm sure, in different ways, has this concept of America first. And one of the things that came out of the G20 is you have to ask yourself whether it's really America last in terms of the types of alliances that are working in the world today. New trade agreements, new diplomacies with countries that hadn't spoken with each other very significantly in the past, and agreements that are being made for two reasons, I think. One is from the standpoint of protecting the commonality of the world and the filling the gap, really, of a receding power versus rising powers, and also, to an extent, a protectionist, an anti-protectionist type of an environment. So when Trump was elected on the idea of being an anti-establishment president, even though he is a billionaire, even though he represents lots of businesses, even though he comes to the office with a tremendous amount of conflicts of interest, which I did talk about last time and which many of you have covered. The reality is he still has a very strong support amongst his voters in terms of who he has manifested himself to be. The idea of being still this anti-establishment sort of maverick person who can go, whether it's to the G20 or whether it's talking to Mexico about paying for their own wall, or whether it's trying to get China to have a conversation with North Korea, and then acting sort of bravado when it doesn't happen. All the manifestations of that kind of bravado are something that his supporters in the States still very much feel and very much adhere to. But what's happened is the rest of the world has changed. What Trump hasn't done, and I spend a lot of time in Washington, more time now actually since he's been elected, is really focus on some of the problems that still exist in the United States and that have altered the landscape globally in the last 10 years. And I want to talk a little bit about that. It's one of the notes here on U.S. banking regulation, on what's happening in the financial system, on the idea of what's going on with central banks, and where we were before we got to the point where Trump was elected, and a lot of these alliances have been reestablished and will continue to be reestablished outside of the U.S. and the world. We still have a problem of banks that are too big to fail. We still have a problem where the initial financial crisis that happened 10 years ago in the United States, that was the result of banks being too large, too speculative, of using the guarantees that the U.S. government provides and has provided to bank depositors since 1933, since an act called the Glass-Steagall Act of 1933. There has been guarantees for depositors within banks. But what's happened since 1999 is the guarantee of deposits for our banks has also become a guarantee for big banks to become bigger, a guarantee for financial crises to become something that the government supports and subsidizes, and that our central bank, our Federal Reserve, also supports and subsidizes. One of the reasons we still have 0% interest rates globally is because the banks, particularly the U.S. banks, and to a lesser extent, to a different extent, the European banks, Japanese banks, and so forth, aren't having the ability to function, to be solvent, to be liquid, without the help of central banks. So quantitative easing, which was the idea of the Federal Reserve, and it exported the idea, it actually got the idea from Japan, but re-exported the idea back to the Bank of Japan and the European Central Bank, is simply the idea of putting money into the market, putting money into the banking system in order to keep the banking system alive. So for 10 years now, the central banks of the world, particularly the G7 central banks, and this is important because it's one of the reasons why ultimately the rest of the G20 has adapted and will continue to adapt other alliances from an economic and currency and trade perspective. But the G7 banks, at the behest of the Federal Reserve of the United States, to support the banking system in the United States, to support too big to fail institutions, has continued to export 0% interest rates. Now, the Fed has raised them a little bit. So the Fed has said, and this has worked both for the last administration and the Trump administration, that the economy in the U.S. is good enough, is growing fast enough for them to start to raise rates a little bit. So in the last, since December 2015 until this June, they have raised rates by a full 1% in 4 different increments of 0.25%. But the Bank of Japan has gone negative on rates, and the European Central Bank has gone negative on rates. And some of the other G7 countries are sort of around 0. So we still have a world where money has helped the banking system, money has gone into stock markets, money has gone into bond markets, debt has been issued very, very cheaply, and it's all been supported by the central bank policy. Now, how do we get from there to Trump, to the kind of voting and where citizens fall in this arena and where they fall on the spectrum and how they feel about their own economies, and how that then translates to all these new power alliances between, say, China and Japan, or between Russia and China, or between Mexico and China, or between Japan and the EU, as was announced right before the G20 started last week, because none of this money is actually going into the real economy. So particularly in the G7, by almost any measure, wages have been pretty stagnant. Actual real growth has been pretty stagnant. Inequality has been the same or higher in many countries, but the markets have been up. The value of bonds has gone up, the value of the stock markets have gone up, the value of bank stocks have gone up, and they've gone up even more so under the Trump administration. And all of that connects back to the fact that in the beginning of the financial crisis, and the cause of the financial crisis, was that we took away one major regulation, the Glass-Steagall Act, which had prior to 1999 segmented off, for safety's sake, people's deposits from the bets that banks were allowed to take, and that they then competitively took, and by 2007 and 2008 would have crashed and burned without this effective G7 alliance of central banks providing them cheap capital, providing the markets cheap capital, and not having that capital pushed into, not having governments push that capital into real infrastructure building, into real development, into real economic growth, except in markets, except in the stock values of corporations and banks, except where corporations and banks could borrow money cheaply, buy their own stock, and continue to push up asset prices throughout the world. So when you're a regular citizen in any country, and you see and you know that the markets are going up, and you know, the media to an extent is talking about how there's growth, or how the economies of various countries are changing for the positive, and you're looking at your own wages, and you're looking at your own family, and you're looking at, in the United States, the significant cost of your health care, or the significant cost of your education, and you don't trust the banks because you keep seeing how they keep committing crimes, and the U.S. Department of Justice keeps on investigating these crimes, yet doing nothing against the CEOs or perpetrators of these crimes. If you're a regular person, you get very antsy about that. And that's partially what happened. And different votes occurred throughout the world in terms of changing leaderships. Most specifically started in the UK with the Brexit vote, in a lot of European votes where there was a shift from sort of more of a left to more of the right. But really it was a shift to this concept of doing or voting for anyone else who wasn't already in office while this was going on. And in the standpoint of the United States, Donald Trump was kind of had good timing. I mean, he was there at a time where a lot of this fragility, a lot of the instability that people were feeling, and rightly so, was something he was able to capitalize on and call anti-establishment, which became anti sort of world collaboration. It became, ultimately, as he stepped into office, a very protectionist and isolationist type of approach. That, in turn, has gotten us to where we are today, but something else happened as well. Along those 10 years, a lot of central banks outside of the G7, like, for example, the People's Bank of China in particular, were very critical of what the U.S. had done financially and what the central banks of the U.S., the Federal Reserve, had done financially. And one of the main things that happened in March of 2009 that Governor Zhao of the People's Bank of China had said at the time very publicly was that this cannot continue. Having the dollar as a U.S. as the main international reserve is inherently unstable for the world. And it wasn't just China that said that. Different other countries sort of came in and said the same thing. And the result was a moving away from the U.S. currency. Not that the dollar hasn't stayed strong. It's still a major economic power. It's still a major military power. But testing the waters for the last 10 years and accelerating in 2011, 2012 into trying to find other alliances, market alliances, trade alliances, diplomatic alliances, geopolitical alliances that have continued to happen, and that we saw ultimately at the G20, because when Trump came in, that just accelerated. His protectionism accelerated a trend that was already happening because of the instability that had occurred in our banking system. Now, when I go to Washington, and speak with congresspeople on both sides of our electorate, so the Republicans or the Democrats. One of the things that you see probably in the world on a more global basis is that there's like super confusion as to what President Trump is going to do versus what he says versus what he means. There's a lot of conversations about interpretations. I was having a meeting recently about Glass-Steagall, about this very act, whether we think our banking system is stable enough, whether banks are still too big to fail, and if they are still too big to fail, what are we going to do about it? Are we going to wait till there's another global crisis, which could occur for a number of different reasons? For example, corporate defaults, which have been increasing because when debt gets issued cheaply, at some point when it can't be repaid, corporations default. Governments can potentially default. People can default. That can catalyze another crisis. Lots of things can catalyze another crisis. But the core of that still remains the banking system. It still remains the private system of providing capital outside of what's coming from the government, what's coming from the central banks, and what goes out into the rest of the marketplace, whether that is in a speculative way, whether that's for corporations to borrow and to buy their own stock, or whether it's to decide whether individuals or small businesses get to have a cut of that lending or a cut of that money to engineer growth at the more foundational level of economies. So going back to this meeting I'm having with a senior member of the Republican Party, Trump's party, who is he's on the Republican National Committee, on the Financial Services Committee, which is the committee in our Congress that decides what kind of legislation gets to even come up for a vote on the floor. So, for example, if Glass-Steagall gets to even have a vote, see the daylight in terms of everybody in Congress getting a chance to say something or have their voice heard on a vote, these are the people, he's someone who decides this. And I walked in and he asked me point blank what President Trump was thinking. Now, I don't really know what President Trump is thinking. I don't think anyone really knows, except perhaps him, what he's really thinking. But what happens is that was a moment where the Treasury Secretary of the United States, Steve Mnuchin, the economic advisor of Trump, Gary Cohn, and Trump were all at odds over this particular legislation. When Trump went to campaign, he had campaigned, among other things, besides being anti-establishment and isolationist, he also campaigned on breaking up banks. He campaigned on going against Wall Street. When he got into office, of course, he didn't select people to be in his cabinet that indicated that. But he didn't really change his position publicly, and he still hasn't actually changed his position publicly on breaking up the banks or bringing back, for example, a 21st century Glass-Steagall, which would not be different from the 1933 Glass-Steagall Act that separated deposits from speculative transactions of banks to begin with. But because there's so much sort of confusion in the administration between messaging, consistency, just internal conversation, that the kind of stuff that goes on in Washington and different countries on a regular basis, people come in from the outside and just even inside Washington, they want information as to what it is their leader's doing, and that's troubling. So when it gets to the level of an international perspective, it becomes more troubling. And what you see going, or what I've seen going throughout the world and being on the ground, is that the kernels, the beginnings of what happened at this G20, where all of these other meetings, besides the one between Trump and Putin, happened between other country leaders. Agreements happened between other country leaders that were in the works in some cases for a few years, and in some cases they were first-time meetings, like with Prime Minister Abe and Moon Jae-in from South Korea. I mean, they've been initial meetings, they've been ongoing meetings, they've been new agreements, but a lot of that's a manifestation of the sort of confusion that starts in Washington or is existing on a domestic basis in Washington, and that simply the world is seeing now as well and deciding, well, just like we started to decide, and I think China really did lead the way in some of this, about having an extra currency, having something to combat, whether it's a basket of currencies, as the Chinese yuan ultimately was a part of with the IMF's special deposit rights basket, or whether it's just simply trade agreements, that there has to be, and in finance on Wall Street it's called diversification, there has to be some other source of diffused power or shifting of power in order to both be able to focus on one's own countries and one's own region. So to an extent, it's a regional realliance, but also on a global basis to ensure that whether it was a financial reason, whether it was related to our financial crisis, our banking system still being shaky, and our central banks exporting this policy that everybody else is kind of in the G7 glommed onto, or whether it's simply to be able to do things without trying to figure out what the U.S. Is going to do or not going to do. It's simply a manifestation of what's going to continue to grow out of the crisis, and I think what's going to grow out of Trump's administration. People, a lot of times I talk and people ask if Trump's going to, if there's I'll ask the question now, but I mean, if there's a question of, impeachment or not or whatever, I mean, I think he's going to be around. Not least because his party's in power, and they're not really going to and he's going to stay around. But what that means is all of these alliances that began in the shadow of our financial crisis, that ultimately led to a shift in voting and led to a shift in power and the structure of power throughout the world, are simply going to continue to happen. And the world's simply going to become more diversified from that perspective as a result of what had happened in the United States and how it's basically manifested in a couple different ways. In terms of Japan, and just going back to that idea of how can money be used for good, and how can we advocate or at least report on what might be happening from the standpoint of financing some of these new power arrangements, whether it is looking at how, for example, the Kra Canal might be funded by some sort of a alliance between China and Japan and Thailand, whether it is a simple high-speed railway between two countries, where does that money come from? And right now, we have a lot of money and a lot of policy that continues to follow the old U.S. doctrine, which again was started in Japan, of cheap money, and whether quantitative easing is continue to be a sort of artificial engine. And that's what we're seeing. If you get away from the G20 and just look at the governors of the various central banks, every time they try to sort of take the foot off the gas pedal of cheap money, something like a market downturn happens, or someone gets upset in the government because it's like, how are we going to fund our debt? Who's going to buy the debt that we are basically creating going forward? And here, Governor Kuroda has been very consistent, actually. There's a graph here I want to show you, and then I'll move back to sort of closing. But if you look at this particular graph of just the G3 and how much central banks have basically been greasing the engines of the market and not the real economies, you look at the ratio. This is just of what central banks have bought in terms of a combination of either government debt or corporate debt, or in the case of Japan, to an extent, corporate stocks as well. And you just see from 2013, what happened was there was a teeny bit of a slowdown in the U.S., or at least a plateauing, and there was an extreme increase in the percent of the equivalent of what the Bank of Japan was holding in assets, in debt, relative to the entire GDP of Japan. And right now, that number is about 93%. So in the U.S. and in Europe, the relationship of the Federal Reserve, who started it all this time around, and the European Central Bank, you've got like a 22–23%, which is really still high, of assets to GDP, and over in Japan, it's really significantly higher. And to put that into perspective, the entire GDP of the world, if we sort of net out currencies, is about 77 trillion. The total amount of quantitative easing by just these three banks, I don't know if I have it, it's about 13 trillion, which is on one of these slides. So you're looking at about 17% equivalent of global GDP is equivalent to the assets of just three central banks. So there's a substantial amount of money that has gone into something that has basically been reconstructed on the central bank's balance sheet as taking debt out of the market, but therefore that debt's not used for anything. It's like governments issued debt, and the idea of a government should be to, say, issue debt to build a bridge or to build a canal or to subsidize wages or to train employees or to pay for better health environments or social welfare, whatever it might be that governments do. None of that money by virtue of the fact that it's still sitting on the books of these central banks, is doing any of that. And so again, the instability that people feel, you know, and the average person in the street's not going to know this or see how it relates to them, but it's because a lot of money is being put into the market, not going back to the public. That's not where the government is putting it. So there's a possibility that as these new trade alliances happen, that more infrastructure development that creates more jobs that can effectively also utilize at least some of this money into purposes of real growth will happen. Otherwise, we're just going to continue to see a lot of the same instabilities, and ultimately, it's going to lead to another financial crisis. It's going to lead to, at some point, and central banks can keep this going for, you know, another 5 or 10 years. It's not like they haven't shown the ability. But ultimately, if repayment has to occur, whether it's a government repaying on its debt or whether it is a corporation repaying its debt, and they can't because there hasn't been real actual growth, things start to default. And so all of these alliances that have grown out of and that will continue to grow out of initial financial instability, where we're at politically, who's running the U.S. and who's running different countries throughout the world, these will continue to happen. There's still going to be an outside alliance relative to sort of the former inside alliance relative to the U.S. But unless that money is deployed in a way that ultimately is positive, it, you know, contributes to actual economic growth, then we do have the possibility of getting to another crisis. Meanwhile, that's going to continue to happen. I mean, you know, what happened at the G20. And you know, Japan's going to be hosting the G20 next year, you know, and the Olympics the following year. So I mean, a lot of things will continue to shift in this direction. But really, there was no conversation at the G20 about the economy, really, or very little, or at least not in major coverage, nor the instability of central bank policy or this idea of money being housed in a way that it's actually shielded from the real economy. So I think that needs to be something that we continue to look at also as journalists. Like, where is this money going? Like, it's easy and it's more kind of sexy to talk about power alliances. I mean, I do it, you write about it, but also following the money is going to be the way to really, I think, add value to people. I mean, and to really how all of these power alliances can actually be captured in a way that supports real growth and real citizens. So that's kind of, we know this. I basically talked about this. We did, you know, even in all of this with going back to banking, where I started, the U.S. banks all did very well on the last set of what they call stress tests in the United States. So the Federal Reserve basically took the answers of the people responding to their own questions, which were the banks, and said, yeah, you guys did good. There won't be another crisis. You know, and I have the quote from Janet Yellen, the head of the Federal Reserve there as well, like we're going to be good. The reality is that completely ignores how fundamentally distorted money in markets and therefore the alliances that have come out of that actually are today. So again, something to continue to examine as journalists as well. While I continue to work with Washington and you know, sort of try to figure out what the consistency is in our messaging, or at least connect it to what's happening versus what's being said. So with that, I want to open it up to you for questions.
Yes. Thank you very much. Yeah, so we will open for questions now. If you have any, please raise your hand and identify yourself when you come up to the podium. If you don't mind, I'd like to ask a couple of questions just to kick us off. Where did I put my questions? Sorry, I moved them. Yeah, a couple of things on, if you watch the cable networks now, excuse me, in the United States, it seems awful what's happening with Trump. Yet you've had 4 state-level elections, I think it's 4, where Republican candidates have won. There seems to be, the disconnect just seems to be so extreme between what you're fed through the cable networks and then what is taking place on the ground with voters. So he really does have a very powerful base, it seems.
Yeah, and I think that's something that really was shown in the election itself, that there was, you know, in both extremes, the right and the left, and even the middle of cable networks, there was a real sense of, you know, that he couldn't win and all of that, and ultimately that was a miscalculation of that base. It was a miscalculation of a couple things. I think I spoke about this last time, but I mean, going into our election, there were, and there still are, and this is why these states are voting as they are, our voters are continuing to vote as they are, there's still a significant amount, both exaggerated and real, of dissatisfaction with average life, you know, with sort of average, you know, people's personal economies. And so when the press talks about the things that Trump has done, and many of them make completely no sense, right? I mean, he's on all sides of issues. I mean, as just anyone following an electorate, as journalist, I mean, he is bizarre. He says bizarre things. He acts in a bizarre manner. And he also doesn't even act with any consistency on his own promises. So I mean, all of that's really, you know, a strange way to have leadership happen. But his supporters are really themselves looking at him as being a sort of manifestation of who they want to be and who they are. So they're dissatisfied with their own life or their own economics, and again, lots of the reasons are relevant and real. And who's the enemy? And the enemy is whoever isn't them, whoever is outside. You know, whether it was the former administration, whether it's the other people in government, whether it's Russia, whether it's China, whether it's Mexico. There's an outside enemy, and what happens is I think that disconnect that the press has from people really underscore, you know, really doesn't evaluate that, you know, that position that his average voter has.
Okay. Do we have any questions from the floor? Otherwise, I'll take them all. No? Okay. I've got a question about Bernie. What is he actually doing now?
So Bernie Sanders, Senator Sanders is doing a bunch of things. He's doing two major initiatives in Washington. One is related to pushing legislation on too big to fail, and in terms of continuing to make the point that our banks are still highly leveraged, highly speculative, highly criminal, and there is a necessity to bring back Glass-Steagall. There's a necessity to also examine how we could potentially you know, be in another crisis if we don't bring back a Glass-Steagall. He's also looking at trade agreements. So he's also looking very closely at NAFTA and how, because there's going to be between now and December 2017, there's a lot of conversations about between our countries about how NAFTA will look, will it change? And again, this is one of these things that on any given day, it's not quite clear how Trump feels about it. But so Bernie's trying to create trade agreements that benefit the country's workers as well as the countries. So he's doing a lot of work on that as well. And he still has a lot of support in the country. He has a foundation now that's kind of separate from what he's doing inside of Washington, on the outside of Washington, that's doing more sort of research and outreach on various issues, on single-payer health care, on the banking issue, on better trade and better worker conditions. So he's actually incredibly active in terms of building alliances inside Washington and outside Washington, and really continuing. I don't know if it gets covered as much globally or even in the United States as his candidacy did, but he's probably you know, the one. I just think even historically, one of the people that's made that transition from, you know, being, you know, in their pre-candidacy life to post-candidacy life, and actually using that to catapult his issues and to get things done, as opposed to just, I lost and I'm sitting back.
I recently had a colleague of mine had a conversation with Sakaki Bara, the former Mr. Yen here, who was involved in the Ministry of Finance during the Asia financial crisis. And his view was that what you've sort of illustrated with some of your slides, with the role of central banks and QE and so on, is actually the new normal. It's not going back to the growth we have seen before, but this is, you know, the economic model is fundamentally shifted. Do you have any views on that?
Yeah, I mean, I think it's a financial model more than the economic model, and the distinction being that this money isn't going into the economies. I mean, it is specifically going into the markets, and you can look at just the correlation. I don't have those slides, but I mean, just the correlation between when a QE measure is done. I think I had those last time. But when a QE measure is done, how the market reacts, which is positively. When it's retracted, how the market acts, or even discussed as possibly being retracted, how the market acts negatively. So it's really become a facilitator of speculation, of leverage, of borrowing to not do anything in the market. So in that respect, it's a new kind of a normal. And that's why I say, you know, it could be 5 or 10 years before, or greater, before QE really changes significantly. But what has to happen at some point, because this debt's going to come due, there's going to be a point, just sheer yearage, where if you issue a 10-year bond 10 years ago at close to 0%, or a 10-year bond 8 years ago at 0%, 2 years from now it still has to be repaid. So unless you continue to borrow more, which will happen as well, if you're a corporation, if you're a government, at some point you actually have to repay that debt. So all of this QE that's occurred in the last decade has really been about pushing that debt forward, and also allowing both governments and companies to effectively issue more debt or buy their own debt and make everything sort of appear positive. But at some point there's actually a debt repayment. There's, just as a separate example, one of, Jared Kushner, who is, you know, Trump's son-in-law, has a building, has a building in New York, 666, and it was, it has a long-term mortgage, and it pays on its mortgage interest rate payments that for 10 years, and then at the end of those 10 years it goes to interest and principal payments. So for 10 years, and of which there's 2 left, he and his companies, his family's companies, are basically not even able to make their interest payments. One of the reasons they both tried and failed to have a Chinese company, Anfang Insurance, get in and sort of help to finance or help to take some of that burden from some of those buildings in there, was because they are struggling, like, to have occupancy rates that will give them enough actual real money to be able to pay their interest. Now, this is 2 years before they have to pay their principal. Once they have to pay their principal, and this is just one example of one guy who happens to be the son-in-law of the president, but once they get to principal payments, if you can't pay your interest, you really can't pay your principal. And you have to borrow a lot more to be able to make up that gap, because usually that means that your payments double, just in the math. So you have to make up a lot more of either borrowing or leveraging or whatever it is you do, or selling off assets which deflate the market, in order to make good on that. So this new normal, yes, it's a way to sort of push that forward, and it has been significantly doing that. But at some point, you know, you have to pay the piper. You have to actually repay the initial debt, even if it's just a portion of that debt. And that's when things, that's why, and I have the slide up there, defaults are starting to happen. So when he says that, it's right. It is a new shift. It is happening now. It will happen for the future. But when companies start to default, which they are, right now they're up to 2009 levels, or 2009 accelerated levels for the last 2 years. And that's reported by the S&P rating agency, which very much messed the last crisis, and they're reporting on defaults. The IMF is reporting on defaults. I mean, these are real numbers. Those things start to happen at some point. It's like, you know, water gushing through a dam. And then, yes, central banks can come in and sort of issue more money or more negative, but at some point you're going to reach a breaking point.
Okay, Siegfried.
Siegfried Knittel, freelancer from Germany. Back to the situation in Japan. I think the reason for to introducing the quantitative easing was that they wanted to end deflation and to have a inflation rate for 2%, and then a real growth will start. Was this not always a failure, to a kind of a wrong thinking, to have to create a 2% inflation and then to have a real growing economy?
Well, that's a really good question, because the whole idea of 2% inflation or having benchmark inflation in a non-growing economy is kind of irrelevant. And which is basically what's happened is, and since Kuroda talks about this all the time, as he did when he announced last week, or the central bank, Bank of Japan announced last week, it was going to buy an unlimited amount of 10-year bonds, which are trading at like 0.1%, right? So it's continuing to do this because he's using the idea that inflation isn't at 2% yet. If you have an outside source of money that has nothing to do with growth, fueling certain aspects, certain measures of the market, like stocks, like bonds, but doesn't actually create or catalyze growth, you're not really going to have inflation. Now, things might inflate. Like in the US, for example, we have really inflated healthcare costs. We have really inflated university costs. Things inflate. But these are not the things that central banks look at. Central banks look at sort of an overall sense of sort of average inflation and not specific to the inflation an actual person would feel in their real lives. And if you are replenishing the market with so much external artificial stimulation, then the whole idea of an inflation peg doesn't even make any sense. There are countries, like for example Brazil, in Latin America, there's very high inflation because there's a scarcity of actual goods, so the prices are going up. There's food inflation, there's actual basic types of commodity inflation that do come into the measures of inflation that central banks look at, which is one of the reasons, for example, that the Central Bank of Brazil has rates up at, I don't know where they are right now, 11–12% and not 0%, because it can't afford to actually, it can't afford to have prices go up by such an extent in its economy that there's like more bloodshed in the streets. I mean, there's real reasons that come into play. But in G7 countries, in Japan, in the US, and so forth, this idea of a benchmark inflation, it's like an old idea for a new reality where there's just an external supply of money not going in to inflate any of the things that went into the inflation numbers to begin with. That's why it's an elusive, it's a non-goal. What he should be looking at, what a central banker should be looking at, if you're going to change and like dump $13 trillion of money into the markets for no reason, or to just basically keep debt up, is you should be looking at where that debt actually goes. That would be a better measure of the pulse of an economy than price inflation, which you're effectively keeping artificially moving away from you.
It's at the back. Yeah.
Yes, Jim Moynihan with the Louis Vuitton Company. And I'm curious about your opinions regarding the infrastructure development. It would seem to me that the Trump administration has been in power now for almost 6 months. I think their time in the batter's box, they've basically swung and missed. I don't see anything that's really been any significant accomplishments. And it would seem to me that considering the base that he has, that infrastructure would be a logical place in which to start doing things, because, first of all, the infrastructure in the country is falling apart. There's a lot of work that needs to be done there. It can basically be done by putting people back to work. It can be done with international trade, for example, if they want to basically try and improve rapid transit by rail. The Shinkansen, the Japanese would love to land some of those contracts. And it would seem to me that instead of just spinning their wheels, that would be a logical area. I think the central banks would take a hard look at it and be very impressed. And I'm kind of curious why after 6 months nothing has happened.
That's a good question. I mean, and it is that sort of infrastructure development is what is being financed to a much greater extent, and should be to an even greater extent here in this part of the world. It's not happening in the United States because so here's the story. So the airport in Washington, there's 2 airports in Washington, D.C. There's one that's close to the center of the city, close to Capitol Hill and the White House, maybe like, 20-minute drive, even with traffic. And then there's one that's like, an hour, hour and a half, whatever, depending on traffic. And it's a lot harder to get to. So there's certain Congress people that they have flights to their home states that go through Reagan National Airport, which is the one that's closer. And there's certain ones that just by sheer, bad luck and not being in a major city or state or, have to go to Dulles Airport, which is the further airport. So Congress only works like 2.5 days a week in Washington. So a lot of them, they come in on Monday and they leave on Thursday. Sometimes they have to work more than that, but that's pretty much what goes on right now. So you fly in on Monday, so it's very important that you have a good transit to the airport. There is no high-speed rail, there's no high-speed connection from the center of Washington to any of the airports. So the ones that have to go to Dulles sort of appropriated money to build a separate lane on the highway that goes to the airport so that all the cars going outside of the state could do that, and the ones going straight to the airport could have their airport lane. So it doesn't really cut a lot of time really at all. It just cuts a little frustration with traffic. So it cuts a little bit. So you'll have these conversations with any congressman on any side of the aisle that has to deal with Dulles, and they all hate it. They all think it's miserable to get there. It takes too much time. Yeah, too much time with their 2.5 day work schedule, and then you'll say, all right, well, this could be a good opportunity to appropriate money for a high-speed rail link to get you from work to the airport, and then they'll say, well, no, that's okay. So it's like this, they'll complain even in their own personal lives, and then they won't appropriate funds. So one of the things that's happening with infrastructure building is, yes, Trump did promise $1 trillion of infrastructure building over the next 10 years. What Congress has said, what the House Republicans so far have said, is no, because how are we going to pay for that? They're also saying we should cut corporate taxes and a bunch of other things that could help to pay for that, but they're not finding in the budget any money to actually pay for that. So this idea, even the high-speed railway that he talked about with Prime Minister Abe in February, and it might be that at some point that happens, and it might be that Japan works in terms of contracts on engineering, it might be that China works on contracts in terms of construction, and it might be that also creates U.S. jobs. But the actual way the appropriation works is Congress has to say yes. And if Congress doesn't say yes, because the money can't be found, and Congress also wants taxes to be reduced, so the money will never be found, and the money that we are issuing in debt is going to the books of our central banks and not into infrastructure development, that's a problem. Like, money has to come from somewhere to be able to do that. And the problem, the quagmire in Washington is where will it come from? And again, those 3 things are, it could come from higher corporate taxes. It could come from actually using some of the money that, instead of going into corporations buying back their own shares, corporations get to be a part of an infrastructure build and make real money and real profit out of really building their company. But that has to happen, and right now it gets stuck. It gets stuck both in Congress and in Trump not being able to push it. We've had infrastructure builds in our country, but both of those things are going on.
Okay, if we are finished with questions, my last task here today is to give you another 1-year honorary membership to the
I haven't used the last one up yet. So.
But here it is. And if I can have again a warm thanks to our speaker today. Thank you very much.
Thank you. Thank you.